The global economy has made a good start to 2024. US growth has remained resilient, but we're also beginning to see signs of recovery in a number of other countries. Canada, Europe, even China has begun to stabilize. I'm Michael Sager, Managing Director and Head of our Multi-Asset and Currency Management team here at CIBC Asset Management. A common thread, particularly in developed market countries, has been the strength of consumers, supported by strong household income growth and positive wealth effects. Consumers have been much more resilient in the face of increased interest rates than we and the market generally had expected. With continued relatively high liquidity in the global economy, plus that resilience of the consumer, we think that growth will remain relatively healthy throughout the next 12 months. This outlook is positive on average for equity markets. There are some risks that we have to be aware of. The geopolitical issues in Europe, Middle East, South China Sea, or the continued frictions between the US and China all mean that we're going to see periodic bouts of volatility in financial markets. In addition, inflation is causing central banks to think harder than seemed likely only a few months ago. Particularly in the US, service sector inflation has remained much stickier than expected. This has caused market participants to reduce the number of rate cuts they expect over the coming months from the Fed. At the beginning of the year, there were perhaps 4 quarter-point cuts expected. At the moment, we're down to between 1 and 2. In some sense, that's a positive thing because it reflects the resilience of growth, which will be beneficial to corporate earnings. But it does mean, again, that market volatility is likely to be higher in coming months, and that periodically equity markets will be challenged as market participants react to new data, new information from central banks regarding progress on inflation. It's important to emphasize the improved outlook for fixed income as a long-term component of investor portfolios. Yields have now reached levels where the long-term return that investors can expect from fixed income, whether that be developed market sovereign or corporate or further out into non-investment grade credit, the outlook for returns is much more constructive. And in addition, fixed income can play an important hedging role in portfolios during those periods of heightened equity volatility. On balance, the outlook for the global economy and financial markets looks relatively constructive. Growth has improved and is likely to continue to do so in coming months. Financial markets will take their lead from that improvement. Certainly there will be challenges and periods of higher volatility and correction, but the long-term outlook for investors who stay invested in the market and focused on the underlying fundamentals appears to us to be a relatively positive one.